On Friday, Wall Street received what should have been a blockbuster domestic data drop, the March payroll report. Look at this chart mapping recent employment figures. March saw a massive rebound of 178,000 new jobs, reversing February's slump, while the unemployment rate ticked down to 4.3%. Historically, robust employment data like this dictates where interest rates go, sending immediate ripples through the bond market. But investors quickly tossed these numbers aside. As San Francisco Fed President Mary Daly pointed out, the falling unemployment rate doesn't indicate a booming job market. It simply reflects more Americans leaving a stagnant workforce altogether. Domestic labor data is acting as background noise right now. To figure out what is actually driving interest rates this week, we have to look outside the U.S. The real shadow looming over the market is a severe geopolitical risk located thousands of miles away from the trading floor. Specifically, the ongoing standoff in the Strait of Hormuz and the broader conflict involving Iran. U.S. allies are running contingency plans, and rumors of a ceasefire occasionally provide brief moments of optimism. Yet the overarching threat to global shipping routes remains high. Because market rates are highly sensitive to these global uncertainties, tracking domestic yield movements requires mapping out the mechanics of international commodity supply chains. It starts with the massive scale of global energy reserves, which are heavily dependent on stability in the Middle East. The continuous threat of conflict creates what traders call a geopolitical price floor, a hard limit on how low oil prices can fall, regardless of regular supply and demand. Investors are looking at these elevated energy prices and recognizing them as a sustained reality rather than a brief, temporary spike. A few Eurocan vessels managing safe passage through the strait recently hasn't been enough to relieve market anxiety or break that price floor. Sustained high oil prices act as the first domino in a transmission mechanism that directly threatens to drag down global economic growth. Those elevated global energy costs are about to show up domestically in Friday's Consumer Price Index report. Markets expect CPI to jump 1% for the month and show a 3.4% year-over-year increase, driven squarely by the surging cost of gasoline. That energy shock doesn't stay at the pump. It bleeds outward into broader transportation costs, driving up expenses like commercial airfares. This flowchart tracks how that mechanical problem unfolds. Energy and oil costs spike. That increase forces transportation costs up, and those higher expenses eventually embed themselves into the core consumer inflation metric. Because global geopolitics are keeping inflation sticky and well above target, the Federal Reserve is effectively paralyzed. Any viable hopes for immediate rate cuts are pushed further into the horizon. With the Fed sidelined, the bond market is adjusting. Short-term Treasury yields remain attractive to investors, while the benchmark 10-year yield has pushed up to 4.36%. These sustained high yields put immediate pressure on the domestic mortgage market. FHA and Ginnie Mae loans are becoming highly sensitive as loan sizes grow and borrower debt levels rise. The risk isn't distributed evenly across the market. It comes down to a localized vulnerability known as loan vintages. This timeline groups FHA loans by origination year. Older loans from 2019 to 2022 are locked into low rates, making this block highly stable. Contrast that with newer loans from 2023 to 2025. These are hypersensitive to rate fluctuations, creating immediate prepayment risks. This specific sensitivity in recent loan vintages is exactly where a global macroeconomic shock converts into tangible domestic institutional risk. The traditional metrics Wall Street watches, like the March payroll rebound and general economic optimism, are currently irrelevant to interest rate movement. Rates follow a very specific pipeline, starting from the Strait of Hormuz, moving through CPI energy sectors, and crashing into FHA mortgage prepayments. If you want to understand the anatomy of the market this week, you have to ignore the domestic noise and watch the global inflation pipeline.